Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't have to, and today we are talking about the delisting risk regarding many Chinese stocks. So this would include stocks like Alibaba, JD.com, and NIO, along with a plethora of other ones. Now, at the time of this video, there is still a giant delisting risk, however, the risk has decreased as of late. So we're going to be going over all of the information that you're going to need to know to make wise investing decisions in foreign Chinese companies. Also, I want you to keep in mind that news changes very rapidly, so although these articles and this news is relevant and current right now, in the future, clearly things are going to have changed by then. So for more stock market news updates, remember to go and smash that like button right now, subscribe if you are new, comment your thoughts down below, and without further ado, let's jump right into today's stories. So some very big name Chinese companies and stocks are facing a potential delisting risk from the New York Stock Exchange as well as the NASDAQ. So these Chinese companies can literally be delisted, booted off, or removed from these exchanges because they refuse to let US regulators audit them financially. And giant Chinese companies are going to be or could be affected by this, such as Alibaba, Baidu, JD.com, NIO, and a plethora of other companies, numbering over 200 companies that are currently in our regulators' crosshairs. So investors should really start to pay attention and not assume that there is no risk here anymore, because the risk is still present for this delisting as of right now. However, I do want to say that not all Chinese companies are at risk for delisting, but a good amount of them, and the reason for this starts all the way back in 2002 with the Sarbanes-Oxley Act, which was implemented when Enron was actually in an accounting scandal by fudging their numbers. So the Sarbanes-Oxley Act of 2002 now requires all public companies to have an audit inspection by the US Public Company Accounting Oversight Board, also known as the PCAOB. However, this has not fared well with Chinese companies, and over 2 decades of negotiations, China has refused to grant access for their financial reports to be audited in many cases. A great example of this was the Chinese company Luckin Coffee, which was listed on the NASDAQ. It was performing very well, except they were found out to have fabricated some of their 2019 revenues, and since then the stock absolutely plummeted, and many investors lost a lot of money on it. However, the Sarbanes-Oxley Act is not the reason for this delisting risk. Actually, it's a newer law called the Holding Foreign Companies Accountable Act, or HFCAA, where the SEC has started publishing its provisional list of companies that are not following these audit rules, which can eventually be delisted if they do not comply. This has caused investors to liquidate foreign Chinese stocks. However, China's securities regulators actually issued a statement saying that positive progress has been made in talks with US committees. However, an official resolution has not been reached yet, and that's why the SEC, or Securities and Exchange Commission, is compelled by law to continue to press ahead with the potential delisting, because this HFCAA law, which is the Holding Foreign Companies Accountable Act, actually says that this is going to be enforced within a 3-year deadline if Chinese companies are not properly audited or their financials are not properly inspected. So the clock is ticking on this. So I'm going to talk more about the HFCAA in more detail right here. So the US Holding Foreign Companies Accountable Act passed in 2020, which forces Chinese and Hong Kong companies to allow the US Public Company Accounting Oversight Board, also known as the PCAOB, to examine their audits. Now, what's the problem with this? Well, the problem is that this act in the United States is against Article 177 in China regarding their securities law. So we have an American policy which is in direct contradiction to a policy made over in China, which prevents Chinese entities from providing information to foreign regulators without first receiving approval from China's Securities Regulatory Commission. So at first this sounds like a simple fix, because once they get the approval, everything is just going to go back to normal. However, the problem with this is that financial regulators in Beijing are actually trying to find a way to clarify what this article actually is saying about foreign companies conducting investigations. So although the law technically does currently prohibit overseas regulators from conducting investigations, they're going to try to find a workaround, and the reason for this act is that these companies risk losing sensitive intellectual property information or data that supposedly carries national security implications, according to the article. And the reason for this is that many Chinese companies are actually backed by their overall state. So instead, the current strategy is to just clarify what information can and cannot be disclosed abroad that hopefully will make US regulators happy. But with that being said, there is no certainty that the SEC will accept these concessions because it's going to be based on what information the companies can actually provide to halt the delisting risk. Because if they're not going to be able to report actual financial results, then it really doesn't matter anyway, and that means there is still going to be substantial delisting risk by investing into Chinese companies. Now, it's currently looking like that Chinese regulators are actually going to adhere to some of the US regulations because they noticed how much this has actually negatively impacted Hong Kong investors and not just US investors. So this is a lose-lose on both sides, and the only way it's going to be a win-win is if they actually comply with US law. So what is going to be the next move? Well, the problem is that the SEC is not just demanding these audits to actually take place, they also want more information about the structure and risk associated with shell companies, also known as variable interest entities or VIEs, that Chinese companies use to list on the United States stock exchanges. So in your brokerage app, when you actually invest in one of these foreign Chinese companies, you're investing into a shell company, and the SEC wants more transparency regarding these various shell companies. So we are currently in the middle of a tug of war where the Chinese national security law prohibits these companies from turning over their audit papers to US regulators. However, the good news is that we have seen positive developments on this, and there is ground being broken in a positive manner. However, this has not prevented the SEC from actually starting a list of names that are going to be potentially delisted from the United States stock market. And we know this because the delisting is actually set to start in 2024 for Chinese ADRs. So at least this pushes the time frame back far enough in hopes that regulators can come to a conclusion that will benefit both the Chinese market as well as the American market, so we can keep these Chinese companies listed on American stock markets. And even if that does happen, who's to say that all 200 plus of these companies that are based in China or Hong Kong that are trading on the US stock market are going to actually comply with these rules? However, I tend to think that the majority of them will be, because it would just hurt them if they didn't comply with these rules unless they had something to hide, or if they have fudged their numbers, such as the case with Luckin Coffee. Another problem is that many of these firms are actually controlled and even regulated by the Chinese government. However, major firms like Alibaba could probably argue that it's not in direct substantial relationships or ran by the Chinese government, even though the Chinese government is a substantial owner of the company. However, other companies are clearly backed by the Chinese government. However, the good thing is that many Chinese investors and these Chinese companies are very attracted to the amount of liquidity and the deep investor base of the US capitalistic markets, which helps these companies overall in the long term. So it's actually in China's best benefit to comply with these various laws so they can continue to be listed on the United States stock exchanges. Also, like I said earlier, we have seen many positive developments as of late, because as this CNBC article says, and I quote, "Regulators from both countries are progressing toward a cooperation plan on US listed Chinese stocks." According to Chinese state media, the report cited a meeting that was very positive. The Chinese government supports the listing of companies overseas and said its crackdown on technology companies should end soon. And this is a very good development, but again, this is a good development, but we are still not at a resolution yet, so there is still a delisting risk, and investors should be aware of that. So we have seen multiple remarks indicating that China may actually decide to ease on the regulatory crackdowns on their tech sector specifically, and even really try to comply with US regulations. So at minimum, the United States and China can meet halfway, so hopefully these companies can remain listed on the stock market, which could be a good buying opportunity. However, the risk is still present, and investors do need to be aware of that, even though positive developments have been made. So with that being said, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and I'll see you in the next YT video.